Welcome to Talking Property. Today I'm joined by Australia's best property analyst, Louis Christopher, as we preview the 2026 Sydney property market. Louis, thanks for joining us.
Good to be here in the new year.
Indeed it is. Let's bring up your scenario slide for 2026, Louis.
Yes.
Each year one of your scenarios tends to come true, one of the four.
Yeah.
It's not always the base case though.
Not always the base case.
But it's got a remarkable habit of being accurate. And we'll pull it apart and have a look at it in detail today. But could you just walk us through your base case for 2026?
Yes, sure. So the fundamental assumptions behind our base case is that we expect migration rates to moderate over the course of the year. We expect no interest rate changes in the first half of the year, but the potential for interest rate cuts in the second half of 2026. We're expecting a little bit of an increase in dwelling completion. So this could be the first year since 2019 where we see a little bit more of a balance between supply and demand in the housing market. When I talk about supply and demand, I'm talking about underlying supply, underlying demand. Overall, we're quite bullish for this year. This is the first year I can think of in a long time where no matter the scenario, we're not forecasting housing price falls for any capital city. We are relatively bullish on 2026, but there are risks in our forecasts.
Yeah, I've got a number of risks that I want to work through with you today.
Yeah.
Not that I'm doubting your forecast, but I think our audience gets most value when we take a deep dive on this.
Oh, Peter, that's the reason why I always run in the report how we went last year. And then when we got it wrong, we talk about, well, why we got it wrong. Because I think it's a learning experience for all of us, not just for me.
Correct.
But for all of us to understand. It gives us better understanding in terms of why the market moves.
I've just outlined here in this slide a number of risks that I see emerging throughout the year, Lou, and we'll work through them. The first one is the share market. I have a view, which doesn't necessarily need to be yours, but the upper end of the property market has been running as confidently as it has for a long time now on the back of share market gains. When I speak to people at certain price points, they're not buying, $5-8 million houses because their wages have gone up. They're moving assets around. They've had a gain in the share market. It's accumulated wealth. Maybe they've made, which is increasingly, we're seeing stories of people made a killing.
Interesting you should say that, Peter, because recall in the last weeks of 25, I believe that the top end of the market was starting to slow down and we were seeing lower clearance rates. Also recall that we're having a reasonably sized equities market correction, which started really from the beginning of November.
Yeah, indeed.
Yeah, continue on.
That is a risk there. You have seasoned operators globally, people like Ray Dalio, that are openly saying share markets are overpriced and set for a correction. And from my experience in real estate sales, if the share market does suffer a major correction, we do feel it in the property market, but only at certain price points or levels of the market. The unemployment rate, are we going to see job losses to AI in 2026 in your view, Louis?
I'm not sure if there will be job losses to AI, perhaps they will be, but one of our key assumptions is that the unemployment rate will move upwards from current levels. We're anticipating it might actually touch 5%, but that in turn will then get the RBA to stop thinking so much about, worried so much about inflation and start worrying about the softness in the economy. Hence the reason why we're forecasting rate cuts in the second half of this year.
Okay, because that's not quite the market's thinking at the moment, is it?
Not at the moment, no, I know.
So you feel that if the RBA were forced to fight either rising inflation or rising unemployment, they would choose which?
I think that they would side on rising unemployment.
Even though that they say their primary mandate is inflation?
I guess where we're coming from with this is that we do take the view that the recent rise in inflation is a bit of a passing fad. We know what's driven it. It was outrageously high electricity prices across 2025, which was in part driven by the elimination of these rebates. Now, I think that will feed through the system and we will see electricity price increases start to moderate somewhat over the course of 2026. And so this is one of the reasons why we think inflation will actually get down to below 3% sometime this year, once again. But there are risks. I could be wrong. Inflation could be more stickier, and that was our scenario too, that we ran, where inflation is actually more sticky than what we actually forecasted as a base case.
Louis, I have to ask you this. If there is a rate hike in the first 6 months of 2026, what does that do to the property market?
All our forecasts will be wrong. Because, look,
Yes.
An interest rate rise came in, if I recall, it was number 6 in our most likely scenarios when we compiled our report in November 2025. And, you know, a week can be a long time in the housing market.
In fairness, your report was essentially out there before the whole data flipped on its head, wasn't it?
Yeah, that's exactly right.
In late November 2025.
That's exactly right. So if we had our time back, an interest rate rise scenario would have made our top 4 scenarios.
Yes.
And now on that scenario, and yes, there is still a risk that we could see an interest rate rise this year. What it does for the housing market, well, naturally it's negative, but it depends on the magnitude of the rises. So let's just say it's a 25 basis point increase and that's all we get. Okay, well, that's certainly going to dent sentiment in the housing market. I don't think it's enough, for example, to create a rout in the market. But I think for Sydney and Melbourne, we would see lower housing price growth than what we have actually forecasted. And you potentially could see a flat housing market in Sydney and Melbourne on a single 25 basis point increase.
So given that Sydney and Melbourne are sort of running 4th and 5th, I think, as far as market strength goes, why would they be the most impacted markets with a rate hike?
Number one, affordability. So it's particularly for Sydney. Sydney is the most unaffordable housing market in the country. Now, recall too that one of our other assumptions is that we are going to see a slower rate of growth with migration. And recall up front, I've said, look, we're going to see a bit of a balance this year between demand and supply. Now, the bulk of migration, overseas migration, comes into our 2 largest capital cities, being Sydney and Melbourne. So if we're right about this relative slowdown, this moderation in population growth, that would actually be a bit of a dampener on the housing market. Then you combine that with a rise in interest rates, and then you can see then the triggers potentially for a slower market in Sydney and Melbourne in 2026.
So the strength of Perth, Adelaide, Brisbane, is that domestically generated in those markets? Or
Absolutely, it is. I mean, look, all those markets are still influenced by interest rate settings.
Yes.
But I don't think a 25 basis point increase only would materially impact upon our forecast for those cities in 2026.
But are we seeing people who are looking at the differential between their Sydney house price and the relative affordability to them of a house in Brisbane moving to Brisbane?
Absolutely.
Yes.
Hence the reason why we've had for multiple years now very strong interstate migration outflows out of New South Wales going into Queensland, going into WA as an example.
So correct me if I'm wrong, I don't want to put words in your mouth, but what you're saying here today is that from a statistical point of view, new migrants into the country are landing in Sydney and Melbourne.
Yep, predominantly.
And existing Sydney and Melbourneites are pushing out, when they move, pushing out into other capital cities to get the price differential or benefit that's on offer.
Correct. That's fundamentally what's been going on for a number of years now.
Yeah, okay, thank you. And when we talk about supply demand balance coming closer together, is that more driven by demand or migration numbers coming back more so than supply numbers coming up? Because I'm not seeing any mass housing supply around Sydney. There's a little bit, but what the government need to do to tackle the issue, we're not within a bull's roar at an anecdotal level.
So last year, it looks like we completed around 165,000 dwellings across the country. This year, we think that number's going to go up to about 180,000 dwellings. When we look at, say, Sydney on its own, we're not expecting a major increase in supply. It'll be an increase of a few thousand dwellings compared to 2025, but you spread that across Sydney and it doesn't look like much at all. no doubt about it. No, this would be more of the fact of the growth and underlying demand slowing down to the point where it's meeting the increase in supply. So at 180,000 dwellings, that's enough to cater for roughly about 370,000 people. And we think the population expansion for 2026 will be below 400,000 people in total.
And what's the government's motive for being so pro-migration, if you like?
Well, it helps with the economic numbers at an artificial level. So it enables them to report a real GDP growth rate. But of course, the underlying number of GDP per capita has been weak for some time and has been falling for some time. So in other words, our living standards have been falling for quite some time. So, you know, if you bring more people into a static economic cake that's not growing materially, that means that everybody's slice of the economic cake has reduced. And that's what's been going on essentially since COVID.
I think most people would lock in and relate to that point, wouldn't they?
I would think so.
Yeah. Louis, I'm not sure how closely you've looked at the land tax issue. Is this something that you've been looking at in New South Wales, where they've frozen the threshold for next year, but the land rate is still floating?
Oh, I looked at it. Looked at it briefly. Yes. I don't think it's something that's going to be material to the housing market overall in Sydney.
Yep.
That was not one that was moving our dial for our forecasts. Yeah. The biggest dial movers on our forecast for Sydney were interest rates, our forecast for a slowdown in migration, and the supply side as well.
So where did employment rate as a material risk or driver of the housing market for you in 2026?
Look, it was up there. It's definitely in the top half in terms of influences.
Yes.
So our assumption is that we will see unemployment nudge 5%.
Right.
For 2026. It shouldn't go further than that. If it does, that plays into some of our more bleaker scenarios that we've got.
And is that driven by corporates moving across to AI, or is that an economic slowdown or a mixture?
I think it's a mixture.
Yep.
The reason why we're a little bit more negative on the unemployment rate is the measures of job ads, the ANZ job ads series, which has been pretty weak of late.
Will we see cost of living relief in 2026, or will it be another case of just, making ends meet for households continue to be very challenging?
I think it's going to stay continually very challenging. One of the fundamental problems we've got in our economy is productivity. So you get real economic growth, real increases in living standard where you can get productivity rates rising. But our productivity rates have been falling. They've been falling since COVID. And it's happened for a whole bunch of reasons, in my view. To increase productivity, you need serious microeconomic reform. The type of reform that we saw from the Hawke-Keating government in the 1980s, continued on by the Howard Costello government in the 1990s. That was a good period of microeconomic reform. But since then, we haven't really had it. Yeah. And I think it's now starting to show in the economy.
If I could just bring up this slide, this really caught my attention in late 2025, where you have a Labor government taking an axe to the public service because
that's a rarity.
Yes, that's right. All in the name of budget repair. So that slide right there speaks to the dire situation in Victoria, doesn't it?
Well, it does. I mean, when you've got a Victoria Labor government having to cut the public service, that's the last thing they want to do.
Yeah, and this feeds into productivity too, doesn't it?
Absolutely.
That's the point you're making.
It does, and quite frankly, for a number of years now, government spending as a percentage of overall GDP has been gradually rising. In other words, the government's becoming a bigger and bigger component of the economy. Now, when you consider government, are they the most productive beast out there that we've ever come across? No, they're not. No. They never have been. Yeah. And this is one of the reasons why we've had lower and lower productivity growth, in my opinion.
If I can bring up our next slide and take a broader look at what the unemployment rate is doing historically, you can see there that where it's at as we closed out 2025 is at a reasonable level. but the trend line slowly but surely is edging up, isn't it?
Yeah, look at it. The trend's been rising essentially since 2022. Gradually but steadily, it has been rising. And then look at it prior to COVID, the trend was easing down. And then we had this, gigantic event being COVID, causing all types of distortions.
The ultimate
in
disruptor.
the economy. Yeah, and it was indeed. And yeah, fantastic. We got unemployment down to record lows coming out of COVID, but it couldn't stay there, of course. And look, I'm not surprised unemployment rose from the record low levels we had, but it's continued to rise. And this in part has been driven by a slower economy, still very strong migration numbers coming through. So more people looking for the same number of jobs and essentially not finding it. Government, of course, trying to take up the slack in terms of, for example, outrageous growth in NDIS. And so therefore government's becoming bigger and bigger as a part of the economic pie. But since it's based on lower productivity and inefficiencies, unemployment continues to rise.
Of those people that are, say, losing their high-powered job to AI or cutbacks in the public service or whatever it might be, who then go on to get gainfully re-employed, I think the sign of a healthy economy is they can get re-employed at the same position or better.
Yeah.
And the sign of a weakening economy is people have to take a job below their pay grade to stay gainfully employed. So they're essentially underemployed, therefore their earnings are not maxing out. Do we have a sense of how people that have gone through the unfortunate experience of losing their jobs or what their chances are of being re-employed at the same level or better?
Not as good as where we were in 22 and 23, quite clearly. Now, certainly not as bad as what we had in the 1990 recession. Yeah. When I was graduating and I couldn't even get a job in a supermarket. And that's how bad it was at the time.
Yeah.
Look, I think it represents a market that's stable in terms of the employment market, but slowly deteriorating. It could be worse, it certainly could be better. I'm more concerned about this trend. Hence the reason why we're forecasting unemployment could touch 5% this year.
Yeah, and are you of the view that AI is going to attack white collar jobs as such more so than...
It already has been.
Yeah.
No question about it. But let's remember with the rise of the PC in the 1980s,
yes.
Great concern was that a lot of jobs would go then. In the end, what it did was made us more productive. And new job creation occurred. It was actually part of strong economic growth at the time. AI still has the potential to do that if we get it right. So I am a believer that, okay, if AI do take over some jobs, there'll be job creation elsewhere. It will be fundamentally okay. And we all know that there are limitations with AI. I certainly don't use it for any of our assessments that we do either on the property side or on the funds rating side. But we will occasionally use it in terms of report writing. It helps a little bit in terms of getting those reports out in terms of just some basic templates you want to do. So we do find some use from it, but I would never get it involved in decision making.
Yeah, indeed. Look, I think binary issues such as accounts, I've had accounts people tell me that it turns a day's work into 15 minutes.
Yeah, that's right. That's its potential. Yeah. But decision making, you just got to be very, very careful about it, and advice you get from it. Yeah. You've got to be very careful on it.
So it's a tool, not all dominant.
Exactly. Yeah. And so at this point in time, we still fortunately need humans, Peter.
Yeah, thankfully. I just think that as the economies go through the cycles that they do, increasingly what we're seeing is corporates are struggling in this environment to grow their top line, their revenue line, and the easiest way to grow profits in their view is to cut costs, and the easiest costs to cut at the moment is human labour into AI as much as they can.
Well, it is a form of microeconomic reform that I spoke of earlier. Yeah. When you go through hard times, businesses get tougher, they get meaner and leaner. That creates productivity, which in turn eventually creates good times.
Yeah. And will this flow over into work from home? Like if you were a work from home and your boss is saying, look, I appreciate that you can and do want to work from home, but I prefer you in the office. Is it a smarter move to start fronting up to the office, trying to head off some of these?
I think it's been a smarter move since 2022.
Yeah.
And those companies who have decided to be soft on their team.
Yeah, indeed. Look, coming over to the next issue that I keep reading about here, the Japan carry trade and what is going on with Japan. Just for those that might not be across it, but could you just quickly explain, because I think people are going to hear a lot more about the Japanese carry trade.
So let's talk about what the carry trade is.
Yeah, correct. Yeah.
So it is when an investor decides to borrow money in a country where interest rates are super low. In Japan. And then re-lend that money out in a country where interest rates are quite high, whether it be Australia or an emerging country, as an example. And that's the carry trade. There are issues, though, for people who do that when suddenly your cheap financing country, such as Japan, has rising interest rates.
Which is where they're heading.
Yeah, that's exactly right. And has all types of ramifications on, for example, the exchange rate that occurs. It can affect investment markets in a very big way. So often when you see volatility with Japanese interest rates, you see major ramifications for world equity markets. And we've been through a phase of that recently.
Indeed. So the reason I've put that in there is that it is an emerging story.
Yeah.
As we know, 5 Christmases ago, we were hearing about this virus in China, and the first we knew about it was they were rolling down the truck and spraying the streets with disinfectant, I assume, or a version of. And it's like, that's an interesting scenario. I must keep an eye on that. It became what it became. A few years later, Evergrande in China imploded, the largest ever corporate failure, I believe. It was monumental, and it had the ability to threaten royal markets in a massive way, but it didn't happen. But this one here, this is big if it implodes, isn't it? We're talking contagion here.
Yeah. Look, so if Japanese interest rates keep rising, let's keep in mind that Japan has been suffering from a stagnant economy for quite some time. You've also had the government trying to pump the economy up with more money printing.
Declining population.
Declining population has been their number one issue.
Yep.
It has the potential to create a rout in equity markets and potentially a global economic recession if it really spun out of control.
So again, we're not saying it's a dominant issue. You're very positive about next year, but these are the sorts of big issues, the big rocks that people should keep one eye on.
These are the risks, absolutely. Yeah. So I think for those who like to follow the housing market here closely, yes, this is an issue to watch. Equity markets is definitely to watch. Interest rates naturally is something we always watch. As mentioned before, what is the level of migration? Is it slowing, or have we got that wrong as a research house? It's still running hot. These are the risks fundamentally to our forecast that we've run for this year.
Louis, coming back to Terry Ryder from Hotspotting, I saw him speak recently. He gave a terrific speech, and he spoke about the things that drive property markets up. And his primary view was the greatest indicator that a property market is going to rise is not interest rates and it's not population numbers, it's infrastructure spending. And he pointed to the $900 billion infrastructure investment by governments of all levels in Australia. Do you have a view on Terry's perspective there?
I think that has a long-term bearing upon the housing market. Yeah. So, for example, 2 markets sub-markets which we think will outperform for the foreseeable future. Number 1, West and Southwest Sydney, primarily because of the secondary airport that's about to be opened, and the Brisbane Olympics.
Okay.
So we've been bullish on Brisbane really since the announcement of those Olympics. That said, though, we must remember what happened in Sydney when we had the lead up to the Olympics and then the Olympics themselves, and it's happened in other countries. Housing prices outperform in the lead up, and then post the Olympics, they underperform, as what happened in Sydney in the second half of 2000 and the first half of 2001. And it'll probably happen for Brisbane as well, I suspect.
I know in all of our recent discussions you've spoken about the outer ring of Sydney outperforming the inner ring.
Yeah.
During 2020, late 2025, we had a number of family, friends, clients say to us, hey, can you sell this property for me in Western Sydney, whether it be Blacktown, Glenwood, Quakers Hill, Merrylands? The outer ring of Sydney is particularly strong, isn't it?
Yeah, and it's been driven in part by the first home buyer 5% deposit scheme.
Yes.
The middle to lower end of the market are more sensitive to interest rate movements, and recall we had 3 interest rate cuts last year as well. And then of course the Sydney population is still growing. And so with the additional people, where can they live? Yeah. They increasingly go to the outer fringes. That's what occurs. So underlying demand for accommodation is stronger in Sydney's outer ring than what it arguably is in Sydney's inner ring.
Well, that would be my experience. So just being clinical in my assessment of things,
yep.
The Indian community, they are in Western Sydney in huge numbers, and I'm talking to give you some sense. You will put a house on the market, and on the first weekend, you have 5 families giving you offers.
Yep.
On this property, and it's exceeding expectations.
Correct.
It is particularly hot, and the Western Sydney economy is not a beat up. That's a very real thing out there.
Absolutely, it is.
Yeah. Now,
absolutely,
when I was growing up, Glenwood was essentially cow paddocks.
Yeah.
And I'm seeing basic Masterton built type brick veneer homes selling for 2.75 million. Like, that's serious money.
And what this does is that over the long term, you'll see a spillover into satellite regions around Sydney, the Central Coast. We've already seen a bit of that. Newcastle, down in Wollongong and further down south towards, say, Kiama. The Blue Mountains themselves as well. Just these satellite areas are increasingly correlated to what's happening with the Sydney market. When the Sydney market moves up, these outer areas move up more.
Throughout 2026, if we go a little bit more granular again, what do you think will be some of the best performing segments of the market?
Once again, the outer ring of Sydney. If we're speaking of Sydney,
yes, indeed.
Itself, just Sydney. Yeah, look, I'm still a strong believer that the outer ring's going to outperform the inner ring in the marketplace. So, we're forecasting as a base case for Sydney as a whole, sort of mid-single digits in terms of price rises. Well, I believe that the outer ring of Sydney is likely to do more than that. It's going to be at the top end of our range that we have, possibly getting up to maybe 8 to 9%. I think the upper end of the market, assuming an economic slowdown, will probably be most challenged. Not that we're expecting an absolute rout. We're not. I think that's one market. Inner city apartments potentially, though that's been underperforming for some time. And one thing I must say is that previously, when Sydney's inner city apartment market's been underperforming, so have other capital cities. But we're now seeing a lot of activity in the Brisbane inner city apartment market right now. That's going through a bit of a boom. So they would be the areas that all the locations and the property types where I would be more negative on.
And that's been the case for some time with Sydney's inner city apartment market, hasn't it?
It's been underperforming for quite a while.
Yeah, now to give people an idea, some specifics, because specifics help people conceptualise. We sold a property in Chippendale.
Yes.
And I had local real estate agents ringing me and just wanting to talk through the sale. And one of the agents was telling me that he sold inner city apartments for clients that sold them for less than they paid 10 years ago.
Yeah.
Is that...
It's showing up in our data.
It's showing up.
So you see that particularly in the CBD of Sydney.
Yeah, so you've got to think at some stage that's going to reverse. Now, you do have to...
You also see it on certain buildings. So
yeah,
there's certain
I was
towers.
going to talk to strata. You've got to talk to strata plans first. If you're buying the wrong building, it'll be a lifetime of pain.
Absolutely.
But there has to be some gems, good buildings in there that are underperforming. People want to get out. And
There is.
They represent a good investment.
Yeah, but you have to do a lot of research on it. You've got to be careful. You do have to read the strata minutes. You need to find out some of the flaws are in the building, and basically every tower is going to have some type of flaw. It's just how bad the flaw is in terms of building defects. Of course, then you can have the disaster scenarios that we had a few years back over in Mascot. My concern is the build quality. What happens on the resale price for these owner-occupiers? Because quite frankly, in Sydney, we haven't had a great track record over the past 10 years of people buying in off the plan and then reselling. More often than not, they've sold at a loss.
Yeah, that's devastating when that happens, a 10-year investment.
Well, you've destroyed a lot of your wealth.
Yes.
Keep in mind, a lot of people gear up going into property. They take out, a loan-to-value ratio of 80, 90%.
And not everyone's a winner in the property market, that's for sure.
No, you've got to be very careful in many respects.
Yeah, so my winners coming into into 2026, Louis, is that I think in the next year ahead, I think home buyers will get a little bit of a better run in terms of the guidance from real estate agents. I think the underquoting laws and improvement will make assessing what a property is likely to sell for a little bit more predictable. Gone are the days where agents will deliberately and systematically quote 20 to 25%.
I think so too. There's been more active monitoring, as we know, and more activity from the Department of Fair Trade in New South Wales. What I wouldn't want to see is the extremes that we've had in Victoria, where they've moved now to publishing reserve prices. I think that's actually gone too far, and that's rather counterproductive for the transparency in the industry, believe it or not.
I do believe it, but the industry bought it on themselves. In Queensland, they've gone the other way. If you've got a property going to auction, you can't promote any price.
Yep.
So Victoria and Queensland have gone in completely different directions.
Different directions.
How to manage
I
that.
think the New South Wales direction is the right way. Clamp down on the dummy bidding, clamping down on the underquoting, have an active department there that's prosecuting agents who are regularly doing this and fudging data, make examples of them. The rest of the industry will fit in line.
Let's hope so. And then the people that I think will be losers in 2026 as such in the property market is anyone with substantial holdings, notwithstanding the points we've discussed today. I think freezing the land tax threshold is going to see a lot of people hit with hefty and unexpected land tax bills in 2026, unfortunately. It was a very, very sneaky tax. Because they didn't actually increase taxation, they couldn't be accused of driving tax up on property investors, but that's essentially what's happened because 2025 was a good year, so the land value is going to increase, the rateable land value is going to increase, but the threshold that normally moves in sync with the increasing land price has not. So unfortunately, I think...
So it's a bit of bracket creep that's going on there.
Big time.
But I just don't think it's going to directly play out in terms of big changes in housing prices.
Correct. But individuals will cop it in the next.
Individuals will cop it. It'll be tougher for investors in some respects in terms of trying to get these properties to run cash flow positive or at least cash flow neutral. Look, from my side, I've had a strong view that one of the biggest reforms we can do is get rid of stamp duty altogether and have a broad-based land tax.
Yes.
You do that, you're increasing the liquidity in the market.
That was Dominic Perrottet's policy, of course.
Exactly, but the answer certainly isn't keeping stamp duty where it is and lifting land tax overall. That is counterproductive in many respects. It will not help affordability in the housing market.
Well, I can assure you it's driving landlords out of the market into other asset classes, and that will flow into, I think, who will be the other victim out of the 2026 property market. I'm actually forecasting a very strong rental market. I'm not suggesting we're going to see 20%, but I think all of the elements are in play where if you dump another 500,000 people or 400,000 people into the country and don't provide adequate housing for them, as I don't see happening, combined with the landlords under cost of living pressures and inflation edging up, I think tenants could find rents start rising again this year. I'm not saying I want that to happen, but everything that I'm seeing suggests that tenants might do it tough, and I wouldn't be surprised to see a 10% jump in Sydney rents in 2026.
Wow, all right. Yeah. Well, when we get to the end of the year, Peter, we'll see who's right about that. I'm not forecasting such gigantic rental increases for Sydney. Yeah. I think the net interstate outflow will offset the net migration inflow, and I do think we'll see a moderation net migration inflow. And I think given how the economy is stretched in Sydney, what people are going to be doing, let's assuming that I'm wrong about migration, they're going to be sharing more. They're going to be grouping together more, and perhaps those net interstate outflows to Queensland and Western Australia and other states might increase.
Happy to be wrong on that one. I'm not hoping that
the man on the ground versus the man with the data.
Correct.
Let's see what happens.
Yeah, happy to do so. Louis, it'll be an interesting year. We know that, and we'd love to see you mid-year if that's okay.
Sounds good.
Thanks very much for your time today.
Thank you, Pete.
And thank you for your time today on Talking Property. We look forward to catching up with you next time.